everyone. I've got the slot after lunch, so I hope you can just shake your feet and shake your hands and give me your full attention, because we really are learning a lot in this room. And I'm bringing together 8 years of research in this paper that CAF has very graciously funded. And it's just about to be published on their website. So it is very numerical, but the position I've taken is quoting from the chair of Shelter Afrique's board, that accountability plus transparency gives you trust. So I'm trying to take that approach that please see the numbers as something that we've put a lot of work in. We want to show how credible local developers that Kenya has can participate in the delivery of affordable housing, which is our national agenda item. So my presentation will just go over this very specific space that I have been studying, and it focuses very much on how can we really get developers to participate. We haven't had much discussion about the framework of the Kenyan program, but basically they have defined interventions on the supply side, on the demand side, and as enabling framework. And to put it very simply, the framework is that the government will assist in providing infrastructure and service land, and developers, both on public and private land, can deliver the housing, and there'll be a guaranteed offtake. The guaranteed offtake will be funded by a fund. The National Housing Development Fund is being debated as we speak, and that will provide the offtake. My point, and then there's also the KMRC that we mentioned in detail that can help people to have long-term financing. The fund will give the social income brackets financing for long tenant purchase schemes, and the KMRC will give families with slightly higher income in the mortgage gap longer-term financing. So what I really studied for the last year since the launch of the program is why haven't local developers who have access to service land, why are they not contributing and participating? And this is the framework that's in the program right now, that the developer will be provided an offtake agreement. The pricing is 50,000 shillings a square meter. The developer will contribute that land, design, and build and finance the units, and thereafter the government will provide the offtake on completion. So it's basically 90% of the cost on verification and 10% after defects liability. What brought me a very interesting angle that we found is most developers are saying we can't deliver at that 50,000 shillings a square meter. But if you drive around Nairobi, you'll see a lot of single-story housing that's being sold for less than 50,000 shillings a square meter. And so we found this phenomenon that I hadn't really appreciated before, which is the universe of small developers is completely different from large developers. And the small developers, their product is the bungalow, a one-story house. Their construction methodology is that they buy the material, they hire the labor. So they're effectively their own contractor. And they deliver at most 50 units a year. They have very limited capital injection in the project because they're getting installment sales. And the average delivery price is 35,000 to the home buyer. Now, if you contrast that with the large developer, the Karibus of Nairobi, Unity Homes, Natureville, Greenspan, Soraya, etc., they're doing a completely different product. They're buying land that's slightly closer to the periphery of the city. It's apartments, so ground plus 4 stories minimum. They employ a contractor, so now it's a different, 2 levels of profit that are required. But they're wearing a developer hat because they're assembling large land parcels, they're servicing this land, they're raising significant equity and debt to deliver the projects. And so their construction price is 31,500 and their sale price is about 65. These are averages, of course. Everything makes a big difference, the unit typology, the location, etc. So why is it so different? We were just surprised, and most people you speak to will say, well, the small developers are just, they don't understand their cash flows, and they're just using someone's money to pay someone else, and they're not paying any tax. But I think numerically, there's an answer to all of it. So we've spoken to a lot of small and large developers, and the small developers can build at 20,000 shillings a square meter. And that's their construction cost. When I'm moving now to apartments, I need a lot more material, I need a lot stronger foundation, stronger structure, intermediate floor slabs, so I have to add a margin for that. The labor that I employ in a large development, all the labor is probably regulated. You have to pay all their taxes, their PAYE, etc. You add a 5% margin for that. And I'm actually the contractor right now who's building it, so I need a profit. So there's the 20% profit margin. So the construction cost, the hard construction cost of the same square meter that I can sell is already 50% more for a developer who can give you scale than the small developer. And now, as a developer of an apartment block, I have to build much more than I can sell. I have to build the staircase, the corridors, so there's another adjustment factor. And then the whammy, which is what the PS alluded to this morning, and that all of us, KPDA, Kenya Property Developers Association, KM, we're all lobbying for, but it just shows how big government is, that while the PS is saying we need zero-rated VAT, it did not come in our budget 2 weeks ago. But that is really the whammy that almost says now on everything else I need to put 16% VAT. So the large developers' construction cost is about 42,000. And bear in mind, these are very small units that we've been looking at. And that's one big policy that we're really, really lobbying for, is please remove our VAT on an affordable house. And what should an affordable house be defined as? In my perspective, I would say a house worth less than $50,000. So I undertook a pilot project, and this is not a desktop study. This is an identified piece of land. And the land is in the satellite town of Thika, which is a good mixed, it's got a lot of industry, a lot of FMCG. It's connected to Nairobi via the Thika highway. You can work in Nairobi and live in Thika or vice versa. I know families doing both in all income brackets. And the land touches a mall. The mall has leisure. And the developer who owns the land is savvy, and he's not willing to participate. So I've worked with him to do the numbers, to do the BQs. And I'm going to walk you through very quickly with the numbers, but please be assured that all this will be available on CAF's website, and we'd even willingly share the Excel backup. So the high-level assumptions are we're going to build 2-bedroom apartments of 40 square meters, pretty dense, 150 units an acre, but that only results in ground plus 3. So half the land is available for the roads and green space. The infrastructure, the site is serviced to the plot, so we only have reticulation on the land. And our soft costs are pretty standard, and our debt to equity is what's available in Kenya. As a developer, you only get 60% of your hard construction and infrastructure cost. And the time frame is pretty aggressive. Once, it's an 18-month construction period, the designs are ready, so just a 3-month approval period, and that's how the cash flow has been done. So the developer needs a minimum IRR of 25% to participate. And this is what we found. And again, this is a heavy slide, but what it's showing is the cost, and this is just cost, right? The cost for the project to deliver, and look at the red circle on the 1-unit column, is 2 million shillings a unit. And it's very easy right now with the Kenyan currency to convert to dollars, just divide by 100. So we're looking at a cost of $20,000 before profit. And what is that cost made up of? So all morning we've heard land is a challenge, but what we found is for well-located land that's well-serviced, and we're going high density, land is not the obstacle. So land per unit is contributing 6%. Again, the infrastructure is only contributing 2% because we're only doing the reticulation. So what is the stumbling block? Why is this developer not participating in the government's offtake? And it's clear that it's the construction cost, which was touched on by CAF and touched on by others, that we have a very, very high cost of construction per square meter. A lot of it has to do with taxes and inefficiencies, the cost of our energy. So all this is really, as the ecosystem works itself out, and which will take time, that is the big stumbling block. And look at VAT. VAT on construction is adding 11% to the project cost. So the summary of what this says is, if I, as a developer, want to build only 150 units, which is a fraction because we want to build thousands more, I, as a developer, have to come up with a million, that 1094 number at the bottom, the equity required. So I have to provide equity for the land, for all the soft costs, for 40% of the hard cost, and for the interest in construction. So I have to come up with all that equity. And why would I do it? For just a 150 unit project, I have to come up with 164 million shillings. And wouldn't my investors or shareholders say, we're not taking that risk because we're just not sure. Well, one, the numbers don't make up, but we're also not sure whether the offtake will materialize. All this is being tested. The government has all good faith. We all believe, and we've heard the PS's call for action. But still, these are first steps in a very ambitious project. So for a developer to say, I'm going to be bold and risk all this, is asking quite a lot of the developer. So what are the recommendations? They're very, very simple. And when I talk about innovative finance, it's not innovative. It's just saying, let's meet the market. The first recommendation is we should have construction finance. And construction finance, a lot of speakers spoke about it. CAF showed some houses that were unbuilt because of the lack of construction finance. It can be structured in two ways. It can be structured within the offtake agreement provided by government, or we can create a separate construction finance vehicle, which is done in many markets. So just as KMRC is being set up to lend to banks to improve the mortgage market, a similar construction financing facility could be set up. Another thing I advocate for is increasing the debt to equity in the construction period. So right now, it's very much 50-50. By the time you add up everything the developer has to do, he's to come up with half the project cost. And I'm just advocating for 60-40. I'm not saying developers should not have skin in the game. Of course they should. But even moving that a little bit will make it much more feasible. And we can improve viability for developers by everything we've talked about, which is the zero-rated VAT and the offtake price and the interest rate. So I've looked at some sensitivities to say this is the current scenario. The current scenario is developers have to pay 16% VAT. Developers have a 15% interest rate, and the debt to equity is 50-50. So they have to come up with 1.1 million for equity, and the offtake price needs to be 65,000 a square meter to be viable, to get them to come. And my argument is, if we move all the factors of supply and improve them for the developer, not only do you reduce the equity required to I'm looking at scenario 4, 715,000 a unit, but you reduce the offtake price as well. So it's going to be cheaper to the government or to any program designer. And this is how I take it further to say the rationale for concessions to developers. I know developers have a bad reputation, but Kenya is quite fortunate that we have credible developers with a track record who've delivered to the market with no concessions, right? So by the total concession given to them, if you do what I've prescribed earlier, so scenario 4, we remove VAT, we drop the interest rate to 9%, we increase debt to equity 60-40, the total concession to the developer is 224,000 a unit. But the unit price goes down by 400,000. So you're getting money on your money. You're getting it back immediately with each project. And that's a positive subsidy multiplier. If I look at it the other way, I would say if the unit is sold for cheaper, and the financing that will be required either from KMRC or from the tenant purchase schemes that are being envisaged will be less because I'm financing a cheaper house. There, I will save 521,000 for the 224 I gave. So to me, and it's a no-brainer. It's just how do you do this and make sure the developers do build what you want to build. So I've spoken through the conclusions, but I want to talk about a very fascinating case study called the Reinvestment Fund, which is actually how Kessia and I met in the US. The Reinvestment Fund is an intermediary, and it provides acquisition, pre-development, and construction financing to developers in distressed neighborhoods. So now you're doing really high-risk work, right? And the reason it was created was the US government had a law that said, bank, if you want to invest, if you want to take a deposit in any neighborhood, so if I want to take a deposit in Mathare, in Huruma, I must lend in those neighborhoods. I don't have the expertise to do that, nor do I want to do such small-scale lending or such high technical assistance lending. And so funds like the Reinvestment Fund were launched to be the intermediary. They got hard commercial debt, which they had a 200 basis point margin, and they lent to developers. But they worked with both the big developers, the private developers who wanted to do the work for tax credits, and the small developers who were the NGOs who knew the neighborhoods, and they could provide the technical assistance. So if a project went through the Reinvestment Fund's investment committee, the developer could go and get tax credits from the state government. And it was putting those two together that made these projects feasible. There's a lot about Reinvestment Fund on their website, but what's very interesting is they launched impact bonds. So any individual could buy $1,000 worth of a bond because they cared in what the impact was, right? And they've got a very good S&P rating. They have 818 individual investors and $2 billion in capital. And what they did best was the risk management. And one of the things that I found most fascinating about Reinvestment Fund is the construction managers were investors in the fund. So they were not going to allow any of the fund officers to lend money on a project if the work wasn't done to the level it was stated it was done. It's just a very interesting way and to feel quite confident that construction lending can be done well, and if we want to unlock housing, we have to unlock it every step. We cannot only look at demand without looking at supply. Thank you. Okay, so these are pictures of things we see all around Nairobi, well-meaning projects by housing cooperatives and SACCOs and developers started and not finished. This is what we want to avoid. And the other thing we want to avoid is what happened in the UK. So when we go high-rise in our ambitions to house as much of the nation as possible, please let's think about all the design implications. Thank you. So perhaps just a couple of questions before we start the next panel.
Good afternoon. My name is Engineer Lasu Cheng. You spoke about in your first presentation about AHP interventions about tax incentives. You came all the way to, you spoke about VAT contributing to about 11% of the project cost. So my question is this. Suppose you, in your recommendation, you say that maybe we should zero rate the VAT. Now my question is, you see, like when you talk about VAT, it's usually a component of the entire project cost. Like in construction, you have cement, you have other materials. So you see, when you zero rate that, it means that then the government will not make money. So how do you expect the government to make money, and yet you want the entire project cost to be zero rated? Thank you.
Okay, so that's a really good thing, and we, KPDA-KM, we spent 2 solid weeks trying to lobby Treasury to show that the economic input into the country by building, we took a factor of 200,000 houses. We're like, within us, we can build 200,000 houses. So don't look at it as the VAT lost, look at it as the input in in the country of 200,000 houses built in the next 2 years, because we can't build right now. It's too expensive for the market. So you really have to think about the circular economy that people have been, that housing plays a role in. You're going to get back much more than you lose. It may be a cash flow issue that you lose money in the interim, but right now it's not even a cash flow issue because these houses are not being built, right? Is there any other? And all this will be available because I think our mandate is to push the discussion envelope. So all this will be fully available on CAF's website once the paper's published. We have time for one more question before we move into the panel. Yes, please. Right there.
Thanks for the nice presentation. My name is Dr. Kamil Sulekule from Tanzania. I have two questions. One is that the comparison between the buildings that were done by the normal people or normal buildings and those done by the contractors is a very good one. But would it be better to compare the high-rise buildings and the normal developments, for example, that would bring balance to cities? Say, buildings that are not more than 3 or 4 stories, that would actually say, let's spend money on the community in general, rather than spending money on 20, 40 stories. When we analyze those buildings, look at the foundations, look at the technology we use, and look at the people where they're living. That could be another comparison. The next one is we, in Africa in particular. He's laughing. Those who call themselves we have enough to live on, building big mansions with big gates and 2 dogs at the gates. And when we compare with the rest of the communities, I think there is a problem there which needs that comparison of yours. Why can't we have a moderate development which balances development for everyone as a community? That's why I think I like that guy who had something from Dar es Salaam. Let's look at ourselves. Let's balance development. Why should one have a multi-million project building for himself and his 2 children, while the others have minimum? And where is this affordability as a community, not as an individual? Thank you.
Okay, I'd like to clarify that what you asked us to do in your questions is what we've done. So we looked at a single-story bungalow versus a 4-story apartment, because the minute you go over 5 stories, you need a lift, and it makes it more expensive. So the 20-story buildings I was showing was almost to say right at the end of the presentation that in Kenya we have this real desire to go high-rise because we feel that's a sign of modernization or fast urbanization, but are we ready for it, or will we make the same mistakes Europe made 30 years ago to cater to their slum problems? Maybe not 30 earlier. So I think we have done that, but we can talk about the numbers separately. And on the final one, I think, it's just all up to us. It's all up to us. My appeal to every funder in the room, I've been back with the right education, the right skill set, and I've been back 8 years and not been able to deliver the housing I wanted because most funders will say we need a commercial return. And if you want a commercial return and you want to lend in hard currency, you cannot expect a local developer in any emerging market in Africa or around the world to hedge that currency risk. So only when we get serious about we want to take risk, and I feel the risk is very manageable with the right people because this is an asset at the end of the day, right? It's very hard to build a half-finished unit, but it's still easier than trying to go collect a solar panel in the middle of Isyola that the person hasn't paid back on. But solar is the name of the game, and everyone's lending to it. So I just would like the same attention to housing, because housing supplies so much for the economy. So with that, thank you very much, and I call my esteemed panelists to the next panel, and I'm always open for more questions after. Thank you.